Central banks. Here's the lowdown on central banks. They're self-regulating financial institutions that control monetary policy in a single or group of countries. And a key aspect of that task is stabilizing currency exchange rates and helping improve the economic situation. Central banks use interest rates as a tool to control the supply of currency, therefore influencing its value. So you'll find they generally change interest rates based on an economy's figures, especially inflation. In the event of a steep rise in prices, the central bank would raise interest rates to withdraw liquidity, cash, from circulation. That's called fiscal tightening, and it positively affects that particular currency's exchange rate. Oppositely, when the central bank engages in a stimulus, it's issuing interest cuts to increase the supply of currency, which boosts inflation rates and reduces the currency's exchange rate.